One of the biggest questions that we get asked is, how much can I borrow? So in today's video, we're going to be breaking down how it is that lenders calculate exactly how much you can borrow, the different types of income that you might be able to use, and the financial commitments that can actually reduce the amount that you can borrow. So at the end of the call, hopefully before you go and fall in love with that dream home, you're actually going to be able to know whether it's a realistic option. But first of all, if you don't know who I am, my name's Josh Tomlinson. I'm the managing director of My Mortgage Finder. We are a bad credit mortgage specialist, and we help people throughout the UK with financial blips buy the homes of their dreams. We arrange about £100 million worth of bad credit mortgages every year, and we have a team here of over 30. So most lenders use a simple formula to work out how much they're prepared to lend to you, and that is called income multiples. And what you'll find is most mortgage lenders will have an income multiple of about 4.5. So for example, if you were earning £40,000 per year, the mortgage lender would look at the £40,000 that you're generating, they would times that by 4.5, and that would give you 180,000. Or let's say if you're a couple and you were earning £30,000 per year each, then the calculation will be simply this: 30,000 add 30,000 equals 60,000. You take the 60,000 and you times that by 4.5, and that would equate to 270,000. So in that instance, the mortgage lender might be prepared to lend up to £270,000. And this is very consistent with most mortgage lenders throughout the UK. But not all mortgage lenders are the same. There are some mortgage lenders who are prepared to lend a little bit more than the standard 4.5 times income multiple. For example, we have a building society, you've probably heard of them, Nationwide Building Society. They have a scheme called the Helping Hand Scheme. And with the Helping Hand Scheme, they can actually lend to you up to 5.5 times of your income. So they would just quite simply take your income, times it by 5.5, and that would give you the amount that they are prepared to lend. Just bear in mind here that there is certain criteria that you need to meet. So let's put this into a real life example. Using the Helping Hand Scheme, the mortgage lender would lend 5.5 times of your income. If you're earning £60,000, then you're going to take that 5.5, you're going to times it by £60,000, and that's going to give you an amount that you can borrow of £270,000. But it doesn't stop there. There are even some mortgage lenders, there tend to be more specialist mortgage lenders, which are prepared to lend even higher than the 5.5 times, sometimes up to 6.5 times or even more. And let me give you a direct example. There is a mortgage lender out there, they are called West One. We work with them very frequently because they will also allow their customers to have some bad credit. So what they'll do is they'll actually take the amount that you earn, they're going to times that by 6.5, and that's going to give you the amount of money that you can borrow. So let's put it into a real life example here. If we take the 6.5 times that West One are prepared to lend in some circumstances, and let's say you're earning 60,000 a year, you've got 6.5 times 60,000, and that's going to give you a potential lending amount of £390,000. So that's all great, and we now know what income multiples that the mortgage lender will look to apply on the amount of money that you earn. But you're probably thinking, what sort of income will we actually be able to use in this calculation? And the reality of this is it's going to be lender specific. And what I mean by that is just simply it will vary from lender to lender. Some lenders will allow you to use lots of different types of income. Some might be a little bit strict. And some of the common examples that we'll see that most mortgage lenders will allow, you're going to have things such as your bonuses and commission that people earn through their employment, overtime that people earn from their employment, self-employed income, second jobs, potentially rental income, and even certain benefit income, such as things like child benefits, tax credits, and disability living allowance. Now, what you will find with the different types of income that the mortgage lenders will accept is they will accept some of these at 100%, but they'll only accept some of these at maybe a lower percentage, perhaps 50%. Let me just give you a direct example of what I'm talking about. Some mortgage lenders might look to use the income that you generate from a second job. So let's say that you have a part-time job that runs alongside your main occupation. What they might do though, is they might put a cap on exactly how much of that income that you can use. So let's say you're generating £20,000 a year from your second job. Because it's your second job, they might say we're only prepared to use 50% of that income. So actually half of it. So instead of that £20,000, they're just going to use £10,000. And then they would use the same income multiples that we discussed previously. So we'd basically have £10,000, not 20, 10, because they're using 50% of it. They would times that by 4.5, which would ultimately give an additional £45,000 that they'd be prepared to lend through that element of your income. So we now know what sort of income multiples the lenders are going to use when calculating how much you can borrow. We also know the different types of income that they're going to be able to use when calculating how much you can borrow. What we now need to think about is what things are going to be looked at and potentially taken off the amount you can borrow as well, which might reduce the amount that mortgage lender is prepared to lend to you. And the basic things that we're going to be talking about here are financial commitments in the forms of loans, credit cards, overdrafts, anything that you're committed to paying out, such as maybe childcare costs, food, car finance, maintenance costs, and even things such as gambling. The more of these costs that you have, ultimately, the more it's going to reduce your disposable income at the end of each month. So what I would say is if you have lots of these, there's a higher chance that it's going to reduce the amount you can borrow. If you have less of these, it's probably not going to impact it as much. Now, you might have some financial commitments and it just still might not affect that income multiple that we spoke of. But generally speaking, the more that you have, it will impact it more so. And just remember, this is all relative to the amount of money that you earn. So for example, if you spend £1,000 per month on loans and credit cards, that could be considered quite a high amount. But if that person earns £300,000 per year, then relative to the amount that they're earning, it would not be seen as a huge financial outlay. However, if we take that example again and they're spending £1,000 a month on loans and credit cards, but they're earning £25,000 per year, then that is going to significantly impact the amount that mortgage lender will be prepared to lend to them, if they're even prepared to lend to them at all. Now, if you want to know exactly how much money you can borrow, rather than just calculating it using the income multiples that we discussed, because by now we know there is more that goes into it than that. That should just be used as a rule of thumb. There are really two main things that you can do. Is you'll find most mortgage lenders have something known as an affordability calculator on their website. And that's going to ask you lots of questions about the amount of money that you earn, what your financial outgoings are, and then it will likely give you a result and say you could borrow this amount of money. The other option you've got is you could speak to a mortgage broker. If you don't know what a mortgage broker is, it's a mortgage advisor who looks at a lot of different lending options and lenders for you, and then they will be able to advise you on the most appropriate lender for your needs. And one of those things will be potentially what the highest amount of money that you can get is, and the most money that one of these lenders is prepared to lend to you. So there you have it. The amount of money that you can borrow from a lender is directly related to, of course, the amount of money that you earn, where that money is generated from. Is it from employment, self-employment, or a second job, for example, and your monthly, financial, or yearly outgoings. Some lenders and most lenders will lend around 4.5 times of your assessable income, but there are some lenders that will go as high as 6.5% or potentially even higher. If you do have any questions, please feel free to pop those in the comments below. Alternatively, you can send us an email and the email will be in the description. So thanks for watching. Please make sure that you hit the subscribe button and you turn on the notifications for more tips on bad credit and all things bad credit mortgage related, and we will see you in the next video.